Good evening, everyone. My name is Kush. Today we are going to be discussing the RSI, specifically momentum. So, RSI, which stands for the Relative Strength Index, is simply a measure of momentum um, of a specific equity. So, whatever chart you're looking at. In this case, by momentum, I mean how strong is the trend that it is currently in, and how long can you expect that to last? One of the most important questions when you get into a trade is, especially if it's an uptrend or a condition where it is trending, is how long is this trend going to last? You know, how bullish is this? How bearish is this? Um, it's been going up. Should I sell? It's been going down. Should I buy? And to do so, we can use a momentum indicator in order to give us a sense of what exactly the momentum is behind the stock. And that will give us a really good idea of just how strong this trend is. So we use RSI relative and with the price. That's what this RSI divergence cheat sheet shows. So many think that when you use an RSI indicator, that it's as simple as RSI goes below 20, that's oversold, and then therefore you buy. RSI is above 80, so it's overbought, and therefore you sell. But really, that misses the whole point of why you would have an RSI divergence in the first place. See, if think about it like this. So if you are in a long position and your momentum, okay, long as in you're wanting the price to go up, you're betting that the price is going up. That's what you're positioned for. And you see the RSI super low, okay? That you are not trading a trending system at that point, right? This is not a trend-based trade. That is a counter trend trade, right? Why is that? It's because the RSI is so low that you are anticipating that the momentum will pick up, go to the upside, and with it, the price will as well, right? So just the fact that the RSI is at some value or another really means nothing, you know? And I'll go as far as to say that often is the case that buying a stock at a high RSI value, like above 80 or even above 50, modestly speaking, is more beneficial than buying an RSI or a stock when the RSI is oversold, because you don't have any momentum to carry the trade forward for you, right? You are going counter, you are trading counter to the momentum that it is carrying up until now. So you really actually don't want to very much care about if the RSI is oversold or overbought, as many people will tell you. That is actually pretty irrelevant. What matters is how is the momentum shaping up relative to the price. And that's where the divergences come in. So this cheat sheet is basically all you need to know about RSI. And it is one of the simplest concepts to understand once you get over that very simple and misleading concept of overbought and oversold. So to begin with, we'll cover the bullish RSI divergences right here. So a bullish RSI divergence is simply categorized by, strong, medium, weak, as in how strong the divergence is, how strong the momentum is shaping up relative to the price. And then you also have the hidden one. We'll go into that in a second. But each of these make very much sense. So when you have a strong bullish indicator, that means that price is forming lower lows, but the RSI is forming higher highs. So think about what that implies. When price is forming these lower lows, right, that is sell side pressure exceeding buy side demand, right? The supply is exceeding the demand. So price is going lower. But at some point, as I discussed in the beginning, you want to know, when will that trend end, right? Every trend ends at some point. And the answer to that can be, not always, but very frequently, determined by the RSI. Now, especially if you use things like support and resistance levels and EMAs and, long-standing high time frame areas of support and resistance and everything, then when you couple it with that, you can have a very, very good win rate and good strategy to determine how these trends are going to be occurring, right? So a strong bullish divergence is simply when the price is moving lower, so sell side is still in control. However, momentum is forming higher lows, right? So their strength is waning. The sell side pressure is waning as price goes lower. That means that there is less of a demand to sell at these lower prices than there was at the higher prices. That's indicative of a reversal. And a medium is simply just equal lows. So, you see a double bottom, you see equal lows. But the second time around, when price comes to that same level, the RSI is forming a higher low as well. So it shows you that the second time around, when price is at the same level, the momentum for the downside is actually decreasing and the upside momentum is increasing, right? And in the weak case, you are forming a lower low, but next time the price goes lower, your RSI is forming an equal high, meaning that the momentum when you are at an even lower price is about the same as the last low that was formed. So again, it implies the same thing. It implies that sell side pressure is waning, okay, and that buy side might finally be catching up in terms of strength in the market. Now, the hidden one is a little bit interesting. This requires a little bit more effort to interpret, but simply put, price is forming a higher low while the RSI indicator is forming a lower low. Now, why is that bullish, right? You're thinking, damn, like price is going higher, but the RSI is going lower. Now, I'm not going to lie to you. Hidden bullish and bearish divergences are not something that I frequently use. In fact, I don't even have them toggled on my RSI indicator. I'll see them myself, but I don't really attempt to trade them that much. And the reason why is because out of all of these different divergences, the hidden, in my opinion, is the weakest, even weaker than a weak divergence, right? Because you're effectively forming a higher low in price with a lower low in the RSI. So that means that RSI, your momentum is lowering as price is going up. The way it's supposed to be interpreted is that you're effectively committing to a reversal trade on the RSI, right? That price is going higher even without momentum on its side. And so now it's the RSI that is lagging the price. In these usual cases, it is the RSI that is leading price. And in the case of the hidden divergences, it is that the price is leading the RSI. So you can see why it's not as appealing to trade that. Likewise with the bearish RSI divergences. You have the higher highs being formed, right, on the strong bearish RSI divergence, while you have a lower low being formed on the RSI. That shows you that, price is going higher, but the demand, okay, the buy side pressure, as price is going lower, is waning, okay, and that's indicative of a reversal because there's just not much buy side pressure and demand to continue this rally going forward. And likewise, the same applies with the equal highs and the lower lows. That is a medium bearish divergence, and the weak higher high and equal high divergence. And again, on the flip side, because bearish and bullish, you can, I've said this before, but you can apply all the things that you learn in an uptrend to a downtrend as well. And in fact, in a later video, I'm going to show you a nice little trick. It's simply just inversing the chart. A lot of the times people have their brain in up only mode, and they can only visualize and validate ideas in the context of a bull market. But simply put, like, it's as above, so below, so to speak, right? The same exact concepts that apply to the upside apply to the downside. Now you get into things like, short squeezes and, you know, how liquidation events occur, especially on downside. And there are some differences in terms of how price moves. There's the common saying that uh, markets and price take the stairs up and the elevator down. The dynamics and the characteristics, not the dynamics, specifically the characteristics of an uptrend and a downtrend are different, but the way and that you trade them and the way you identify them are the same. So that is a brief video on the RSI. It is a very, very simple indicator. As with everything else, it is only when you combine them with other things to get confluence that it really starts to give you an edge. And this is why we have the educational series going, because you need to have a comprehensive view on a couple of different things in the chart. You want to have a good sense of where the liquidity is, right? And by liquidity, that's simply an SR level, right? Where the bulk of the trading is, how strong of a trend it is, right? And also, and vice versa, how weak of a trend it is. And then also, on top of that, you have other things like sector rotations and thematics and all that. That will be covered in the fundamentals series. But that is pretty much it. Like, combining all these very simple concepts, and I will post this cheat sheet. I believe I already have it posted on the educational channel, but I will post it one more time and make sure it's pinned for everyone to be able to see. But it is a very simple concept. It only really starts becoming relevant once you add everything in together. It's very much like mathematics, say, right? Math, you have to learn the addition and subtraction in order to learn then multiplication, right? Because think about it, all multiplication is, if you're doing 2 times 2, that's 2 plus 2, right? If you do 2 times 3, that's 2 plus 2 with an extra 1. So 2 plus 2 plus 2, that's addition of 2's 3 times, right? So all these things are building blocks on one another, and they all come in handy. So thank you very much for watching. Have a great rest of your day.